welcome to the Stock Market Palantir. Today we are going to talk about AMBR.
AMBR, yeah. Amber International Holding Limited. This is maybe the most fascinatingly volatile stock we've seen all year. It's got such a complicated backstory. It came out of this, transformative reverse listing back in March 2025, where they essentially plugged the digital wealth division Amber Premium from the parent crypto unicorn Amber Group right into the shell of the old iClick Interactive.
And that complexity it boiled over in late November. We saw this absolutely massive volatility event. The stock shot up, over 60% in a single day. And the trigger for that was the board authorizing a, frankly, dramatic $50 million share repurchase program. And I think that's where we really disagree. Was that huge price move a real fundamental validation of Amber's new profitable model? Or was it, just a flash in the pan, an anomaly engineered by technical scarcity?
That tension between the technicals and the fundamentals is exactly it.
Well, I'm firmly in the camp that this volatility is justified. I think the price action marked a critical and honestly a long overdue repricing of the stock. AMBR has proven itself as a legitimate, high-margin way to get exposure to institutional crypto adoption in Asia. And management's move, the buyback, that's the ultimate signal that the business is sound and ready to generate a lot of cash, which made it just profoundly undervalued before that spike.
See, and I come at this from a completely different angle. I'd argue that the volatility was, it was a classic powder keg technical squeeze. It wasn't driven by the market suddenly recognizing some hidden value. No, it was driven by sky-high insider ownership, almost no tradable float, and a corporate action that was basically designed to prey on that illiquidity. And, the supposed profitability that supports this whole thing, it's incredibly fragile, and it's masked by some very critical accounting complexities and, frankly, severe governance dependency on the parent Amber Group.
Okay, let's look at the evidence that just demands a higher valuation, though. The pivot from the old, loss-making ad tech firm, ICLK, to a profitable digital wealth platform, this is proven now. It's not a theory. The Q3 2025 results show a definitive swing to positive operating income of $1.4 million. That is a crucial threshold they've crossed. And more importantly, they reported a gross margin of 72.3%. That kind of margin, that's totally in line with a top-tier financial services or software model. A completely different universe from the old business.
The margin improvement is, it's undeniable. I'll grant you that. 72% is a great number for a service offering like that.
Exactly. And the strategy backs up that margin. AMBR is laser-focused on institutional clients and high-net-worth individuals with Amber Premium. They aren't out there chasing, volatile retail money. And you can see it in the numbers. They're managing $1.84 billion in assets on platform across only about 5,100 KYC'd users. That implies an average account size deep into the six figures, which suggests sticky, sophisticated capital. So management that clearly believe the stock is mispriced relative to the quality of that capital, which brings us right back to the buyback.
The buyback is the hinge, I agree, but I see it as a weapon, not just a sign of conviction.
Look, a $50 million buyback authorization, which, before they announced it, was nearly 40% of the company's entire market cap. That is just an unprecedented signal of management's bullishness. No board, no management team allocates that kind of capital unless they're expecting not just significant free cash flow, but they also believe the market is fundamentally wrong about their future. They are literally using their balance sheet to force a repricing, and the market's reaction, as violent as it was ultimately correct to recognize that conviction.
I see why you'd lean so hard on that conviction signal, but let's actually break down the reality behind the Q3 financials, because that's what makes the whole thing look a little suspect from an outsider's perspective. The profitability they reported in Q3, while it's, positive on paper, it's structurally so fragile because of something they call WFTL assigned contracts.
But they're disclosed. It's not hidden.
Oh, they're disclosed, absolutely. But disclosure doesn't change what they are. And what they are is a critical accounting transfer. These contracts, they effectively assign a chunk of the consolidated net income from the private parent, Amber Group, directly onto the public company's books. This income isn't being generated organically by Amber's main business alone. And that mechanism, it creates massive related party risk. I mean, if a private parent can just decide to assign or, retract contracts that make up your profitability, then the public company doesn't really control its own fate, does it? It's an engineered dependence.
And that dependence is why the stock was so cheap before. The buyback changes that whole calculation.
It changes the calculation through scarcity, not by fixing the governance. The market structure here, not the fundamentals, drove the size of that spike. Just consider the ownership. Insider concentration is at 76.4%. That leaves an incredibly thin public float, maybe 22.1 million ADSs. So the $50 million buyback they announced threatens to soak up almost 90% of that available float. This is a classic mechanical setup. It's a corporate threat designed to flush out short sellers who were banking on liquidity that just suddenly, poof, vanished.
So you're saying big institutional shorts got trapped in dark pools.
That's exactly what the data suggests. We saw really high off-exchange volume, 44 to 52% of total volume. And that was combined with off-exchange short volume ratios hitting as high as 45 to 48% in the weeks before. And for our listeners, that's a key tell. A high off-exchange short ratio suggests that, smart money was shorting this thing in dark pools, thinking they could easily cover whenever they wanted. The buyback just pulled the rug out from under them, creating a forced mechanical rush for the exits that had nothing to do with fundamentals.
Okay, let's dig into that tension then. The superior business model versus this related party risk you see as existential. I still maintain that the 72.3% gross margin and the swing to profitability prove the new model works. The profit is real. The services they offer are high value. And the parent company backing, that's not a liability, it's an asset. The parent is backed by Tier 1 investors, Temasek, Pantera Capital. Why would they risk a NASDAQ-listed vehicle? The parent needs AMBR. It needs it as a transparent, regulated way to access U.S. capital markets. That need creates a very strong incentive to keep things stable.
I just can't agree with that read of the governance. I mean, sure, Temasek's name is a great reputational asset for the parent, but it doesn't change the legal reality of these WFTL contracts. The parent's need for a U.S. listing doesn't guarantee the public company's sustainable profitability. Those WFTL contracts give the parent a lever, and we saw them use it in October 2025. They shuffled the contracts over to another affiliate, AG Global Technology. So this isn't just an accounting entry. It means the parent controls the profit spigot for the public company. If the regulatory environment changes, or if the parent just decides it needs that cash internally, they can turn the tap off, and AMR's profitability could just evaporate overnight. The high margin is dependent. It turns AMR into more of a managed beneficiary than a real standalone business.
But those contracts represent real economic activity, yield strategies, execution services that AMBR is now entitled to. That entitlement belongs to public shareholders. And if we agree the economics are real, then the focus has to go back to the buyback. You see it as just a mechanical weapon to corner the market. I see it as undeniable conviction backed up by the financials.
Which takes us right back to who really controls the financials in the first place.
Exactly. And look, the company had just under $40 million in cash in Q3. Authorizing a $50 million buyback signals a confidence level that goes way beyond their current balance sheet. It implies they are expecting huge, rapid, free cash flow in Q4 and into 2026. This is a deliberate, strategic flex by the board to force the market to stop seeing it as a distressed shell and start seeing it as a growth fintech. That confidence is the real substance here.
It's a compelling narrative. I get it. The management signal is strong. But have you really considered the brutal math of scarcity when you're trying to force a corner? Let's just assume for a second the conviction is 100% genuine. Even then, the mechanism is coercive. We already said the buyback covers almost 90% of the public float. This isn't just management saying, hey, we think our stock is cheap. This is a public threat to every single institution that is short this stock. When the supply curve goes basically vertical because of a massive, mandatory buyback, short sellers face a nightmare scenario of illiquidity and forced buy-ins. The 60% surge wasn't about value. It was about the supply of shares simply disappearing.
Okay, but even if the catalyst was purely mechanical, the result forces everyone to look at what they're now holding. And that underlying asset is still attractive, which brings us to the true investment profile.
Is it a long-term institutional play or a short-term momentum trade? I say Axio AMBR is a crucial Trojan horse for sophisticated crypto exposure in Asia. They've got growth pillars focused on the future, like real-world asset tokenization, and they're using acquisitions like Sparrowtech to get key regulatory licenses in places like Singapore and Hong Kong.
The regulatory angle is a positive. I will acknowledge that.
And what's more, the business shows resilience. The execution solutions revenue grew sequentially from $2 million to $3.2 million in Q3. That provides a natural high-growth hedge against the cyclicality you sometimes see in wealth management. So this is way more than a momentum play. It's an undervalued piece of a global crypto powerhouse.
See, I look at the investment profile much more skeptically. The institutional branding is, slick and deliberate. But that crazy volatility event was fueled almost entirely by raw retail psychology. The whole narrative became the buyback squeeze. You had platforms like Reddit's Wall Street Bets circulating the 90% of float math, creating massive FOMO. But, and this is critical, there is a clear lack of understanding among those traders about the WFTL contract caveat, the very thing that determines if that Q3 profit is even stable.
So you're saying retail is savvy enough to calculate float percentages but not to read a 10Q?
I'm saying the narrative simplifies a complex risk into a simple story of scarcity, and we can't just ignore the fundamental weakness that was there before the engineered transfers. The main organic revenue stream, wealth management, it actually declined sequentially from $11.5 million in Q2 down to $7.5 million in Q3. That's a pretty big drop, and it suggests that organic revenue stability is highly questionable without those affiliate transfers. If the crypto market softens, that core revenue is the first thing to get hit hard, leaving the whole structure dependent on the parent's accounting generosity.
That decline is a known cyclicality in yield generation. The fact that the execution business grew by $1.2 million sequentially speaks to a resilient, diversified model. This isn't iClock anymore. It's a profitable, regulated, strategic U.S. listing for institutional access to Asia crypto. The valuation correction kicked off by the buyback was inevitable once management showed its hand.
It's a necessary piece for the parent strategy, no doubt. But the question is whether it's a stable, independent investment for public shareholders. I just think the dependency from those WFTL contracts, combined with the engineered scarcity that fueled the price, it just screams extreme risk masked by a technical frenzy. The illiquidity is a feature, not a bug, and it's designed to serve the parent, not necessarily the independent investor.
So to summarize my position, the AMBR story is a successful corporate turnaround. It's supported by undeniable financials, that key Q3 profit, the superior margin, and a powerful technical signal with the $50 million buyback. And while there's related party risk, sure, the company has established itself as a profitable NASDAQ entity, providing crucial institutional access to the Asia crypto market, which fundamentally justifies a much higher valuation.
And I see why you'd focus on the pivot and the margin. But for me, the market structure anomaly masks critical and frankly volatile accounting risks. The spectacular volatility is a consequence of engineered scarcity and financial transfers designed to prop up the public company. For an investor, the calculation is incredibly complex. You have to weigh the potential for a massive technical short squeeze against the fundamental fragility of a business whose profits depend entirely on the private parent's ongoing strategic decisions.
It's clear then that AMBR presents one of the highest risk, highest reward profiles we've looked at, where corporate structure, technicals, and fundamentals are all just deeply intertwined.
Absolutely. Investors have to decide if they're buying a long-term, regulated institutional player with clear revenue streams, or if they're just riding a temporary market corner where the underlying economics are, well, arbitrary and subject to the whims of an affiliate.
Thank you very much for hearing us. Let us know in the comments what is your opinion and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.